There's a shadow over the global economy, silent, mathematical, and visible. A structure so vast that no government, no regulator, no central bank truly understands it. Its value exceeds $600 trillion more than 6 times the size of the entire world economy. And yet, it doesn't build a single bridge feed, a single person, or produce anything real. It is the derivatives market, the hidden engine of global finance. It nearly destroyed civilization once. Now it has returned 10 times larger, 10 times more fragile. In 2008, the world watched the fall of Lehman Brothers like a slow-motion detonation. AIG imploded under the weight of promises it could never pay. Banks collapsed in sequence, their balance sheets infected by invisible contracts no one could untangle. Governments panicked. Central banks printed oceans of money to prevent a total freeze of the system. It took $29 trillion in global bailouts, the largest transfer of wealth in human history, just to keep the lights on. But the lesson wasn't learned. It was monetized. Instead of dismantling the bomb, they rebuilt it larger, faster, more complex. Derivatives were sold as safety nets, as risk management tools. In truth, they were accelerants, amplifiers of greed disguised as instruments of stability. They allowed banks to bet trillions with only millions in collateral to turn risk into profit and profit into addiction. Today, that addiction runs through every artery of the global economy. Your mortgage, your pension fund, your savings account, all indirectly tied to this labyrinth of synthetic promises. When interest rates rise, when currencies tremble, when one bank fails, the chain reaction doesn't stop at Wall Street. It moves through London, Frankfurt, Tokyo, Shanghai. A single missed payment can ripple through continents in seconds. The machine hums quietly now beneath headlines and politics. But the numbers are unstable. Volatility is back. And the same pattern that ended an era in 2008 has already begun again, only this time. There's no bailout big enough, no government strong enough, and no pause button left to press. Because this isn't just another bubble. It's the financial weapon that ends the cycle itself, and it's ticking. Every great financial illusion begins with the same promise that human intelligence can outsmart chaos, that numbers can conquer risk, that the invisible forces of markets can be controlled through equations, derivatives, and leverage. It's a story as old as credit itself, retold in modern form through code contracts and computers. Derivatives were the crown jewel of that belief. Born in the 1970s, they were designed as tools of insurance, elegant mechanisms to protect against uncertainty. A farmer could lock in the price of wheat before harvest. An airline could fix its fuel cost months in advance. A global company could hedge against exchange rate fluctuations. On paper, it was stability. In reality, it was the birth of a parallel economy built entirely on bets. A derivative doesn't require ownership of the underlying asset. It only requires belief. Belief in direction. Belief in movement. Belief that someone else will take the opposite side of the bet. The system thrived on that confidence. Each trade created a new layer of interconnection. Each layer multiplied exposure. And in time, what began as insurance became speculation, then addiction. Banks discovered the hidden alchemy by creating derivatives. They could turn risk itself into a product. They could sell exposure, buy protection, hedge the hedge, and earn profit from every link in the chain. Every bet required a counterparty. Every counterparty spawned another. The system expanded like a neural network without a brain, trillions and notional value linking institutions, countries, and currencies in ways no regulator could map. To outsiders, it looked like innovation. To insiders, it felt like invincibility. Mathematical models predicted safety. VAR value at risk calculations reduced existential danger into decimals. And because the model said failure was statistically impossible, leverage became infinite. It was the perfect illusion. Risk appeared to shrink, even as exposure exploded. But complexity hides fragility. The more the system grew, the less anyone understood it. No one could see the whole network, not traders, not CEOs, not regulators. Each node believed it was protected. But the protection was just another promise, another derivative. The entire market became a hall of mirrors reflecting confidence back at itself. By 2007, that illusion met reality. The subprime mortgage crisis exposed what derivatives had become: a web of synthetic obligations so vast that a single default could trigger a cascade across continents. Credit default swaps, the instruments meant to insure against loss, instead multiplied the damage. AIG collapsed under $500 billion of these promises. Lehman Brothers imploded with $35 trillion in derivative exposure. When they fell, they didn't just fail, they infected everything connected to them. Liquidity froze. Banks stopped trusting each other. The global financial system nearly went dark in a matter of days. And yet, from that darkness came the great paradox. Instead of dismantling the machine, governments decided to merge with it. The Federal Reserve printed money on a scale never seen before: $4 trillion in the U.S. alone. The global total reached nearly $29 trillion. The narrative was stability. but what they truly created was dependence. Every bailout reinforced the system's belief that it could never die. That belief is the true contagion. It allowed derivatives to grow tenfold in the next decade from $60 trillion to $600 trillion. The same instruments, the same banks, the same logic, only larger, faster, and deeper in every national balance sheet. 4 American institutions, J.P. Morgan Citi, Bank of America, and Goldman Sachs, now control over 90% of U.S. derivative exposure. Each one is bigger than the entire financial system of 2008. Each one is linked to every other. The architecture is breathtaking and suicidal. Derivatives tie together interest rates, currencies, sovereign debt, and corporate credit into one unified web. When one strand moves, the tension spreads through all others. A small shock in Japan, a currency shift in Europe, a property collapse in China, each can trigger losses measured not in billions, but in trillions. And here lies the heart of the thesis modern finance no longer mitigates risk, it monetizes it. Every crisis is repackaged as opportunity. Every bailout becomes proof that the system works. The illusion of safety breeds the reality of collapse. This isn't a financial market anymore. It's a self-replicating algorithm of leverage feeding on itself until it consumes the real economy beneath it. Governments, corporations, and citizens all orbit around this hidden core of synthetic value. It powers the markets, funds the deficits, and dictates monetary policy. But like all empires built on confidence, it has only one enemy: time. Because history doesn't repeat, it compounds. And every cycle built on leverage ends the same way, quietly at first, then suddenly, then all at once. History proves it again and again. Stage. 𝐻𝐻𝐻𝐻, the birth of the invisible empire. Every empire begins in silence. In the 1970s, as global finance left the gold standard and entered a world of floating exchange rates, risk became unmanageable and opportunity infinite. Traders, economists, and mathematicians promised a solution: synthetic contracts that could transfer volatility. The first derivatives were small, elegant, and rational futures and options designed to protect farmers, exporters, and corporations. They were born from fear, the fear of uncertainty. But soon, fear became business. Wall Street discovered that the same mathematics used to hedge risk could be used to create it. The Chicago Mercantile Exchange turned volatility into profit. By the 1980s, swaps and forwards replaced insurance as the currency of power. Banks began writing billions in contracts, each one a private universe of promises between two institutions. No oversight, no sunlight, no limit. It was the beginning of a hidden empire built not on steel or land, but on equations and leverage. Every contract created a ghost, a future payment that might never materialize. And those ghosts multiplied? By the 1990s, the notional value of derivatives had crossed $100 trillion, exceeding the GDP of every nation on Earth combined. To regulators, it looked like sophistication. To bankers, it was control. To history, it was the seed of collapse. But the pattern had already begun. Stage 2, the era of infinite leverage. The 2000s were an age of triumph. Globalization was peaking, the internet was booming, and money was cheap. Derivatives became the oxygen of finance, invisible but essential. They allowed every form of debt to be repackaged, sold, insured, and resold. A mortgage in Ohio could be transformed into a bond in London, hedged in Tokyo, and insured in Zurich, all without anyone ever owning the house. Each layer created leverage. Each hedge required another hedge. Soon, there were bets on the bets, and then bets on the insurance for the bets. Banks used them to make money out of thin air collateralized debt obligations, credit default swaps, synthetic tranches, language so opaque that even insiders couldn't explain it without spreadsheets and prayers. The illusion was perfect as long as prices rose, everyone won. And for a while they did. Bonuses soared. Risk models showed calm seas. But the sea was lying. When housing prices fell, the web tore apart. Lehman Brothers, 158 years old, the fourth largest bank in America, had $35 trillion in derivative exposure. When it failed, those contracts turned toxic overnight. AIG, once the fortress of global insurance, had written $500 billion in credit default swaps it couldn't honor. The result was contagion. Banks stopped trusting each other. Credit markets froze. The system designed to distribute risk had instead connected every node to every failure. It took $29 trillion in emergency liquidity loans and guarantees to stop the implosion. But that rescue didn't heal the system, it mutated it. Regulators promised reform. The Dodd-Frank Act created clearinghouses to track derivative trades. But the rules were shallow, the lobbying relentless, and the money overwhelming. By 2015, the market was larger than ever, $600 trillion in notional value, most of it traded privately between banks, unseen, unregulated, and untouchable. And this time, the center of gravity had shifted. Not thousands of players, but 4, JP Morgan, Citibank, Bank of America, and Goldman Sachs controlling over 90% of exposure in the United States, each one holding more risk than the entire 2008 system combined. It was efficiency, they said. It was fragility disguised as perfection. By the time they realized, it was too late. 𝐁𝐵 staged through the fragile giant 2020-2025. The 2020s began with fear and ended with denial. After the pandemic, global debt soared beyond 300 trillion. Governments printed trillions in stimulus, believing money itself could suppress entropy. But derivatives, the silent amplifiers of risk, didn't vanish. They adapted. Interest rate swaps, credit derivatives, and currency contracts grew in scale and complexity. And when inflation returned in 2021, the machine began to shake. In less than 2 years, the U.S. Federal Reserve raised rates from near zero to above 5%, the fastest tightening in 40 years. For banks holding trillions in long-term assets, it was a death sentence. Losses accumulated quietly on balance sheets hidden under mark-to-model accounting, meaning they simply pretended the pain didn't exist. But the derivative books saw everything. Every rate move triggered collateral calls. Every shock in currency or credit rippled through the web. Then came the visible cracks: Silicon Valley Bank, First Republic, Credit Suisse. Each one failed for a different reason, but beneath them all lay the same invisible threat exposure to interest rate derivatives that no one could unwind in time. Meanwhile, commercial real estate began to collapse. Office towers stood empty. Loans rolled over at triple the prior interest rates. Each default triggered credit default swaps, the same contracts that had destroyed AIG in 2008. But now the exposure was global, cross-border, algorithmic. In Europe, Deutsche Bank still carries over $40 trillion in derivative exposure, more than 10 times Germany's GDP. In Japan, government debt exceeds 260% of GDP, much of it hedged through interest rate swaps that will implode if yields rise. In China, trillions in hidden local government debt and collapsing property values have already begun to bleed into global markets through currency and credit derivatives. It is the same pattern magnified through time. Each cycle expands the scale until the next failure becomes uncontainable. What was too big to fail in 2008 is now too big to save. The interconnectedness that once made finance global now makes it terminal. A single spark, a default, a rate spike, a geopolitical shock can ignite a chain reaction faster than governments can respond. Because, this time, the system is automated. Trades execute in microseconds, losses cascade in hours, and confidence, the only true currency, vanishes in a day. Picture this: screens flicker, liquidity evaporates, clearinghouses halt settlements as collateral calls surge beyond control. Bank accounts freeze, and the entire architecture of money folds inward on itself. That's not prophecy, that's math. The leverage is written, the fuses are lit, and the timeline is short. History doesn't repeat, it accelerates. The first empire of derivatives collapsed quietly. The second was rebuilt in its ruins. The third is collapsing now, not in a slow crash, but in a compression faster, deeper, irreversible. The pattern has completed its loop. The countdown has begun. Section 1. The Present Illusion, 2025. We are living inside the echo of 2008, only louder, faster, and more fragile. The numbers on the screens have grown, but the foundations beneath them have not. Every government, every corporation, every household now lives on borrowed time and borrowed money. Interest rates, once the heartbeat of global finance, are now the detonator. In 2021, the world celebrated recovery. By 2023, the cost of that recovery began to surface: debt service, inflation, insolvency. Today, in 2025, central banks stand trapped between inflation that won't die and economies that can't survive another tightening. Each decision they make triggers unseen consequences across the $600 trillion web of derivatives. When they raise rates, banks lose. When they cut rates, currencies collapse. Either way, someone somewhere explodes. Look closer, the pressure points are multiplying. Commercial real estate is imploding. Towers in San Francisco, London, and Shanghai are worth half their 2019 valuations. Each default sends a tremor through credit derivatives. Government debt is metastasizing the United States at $36 trillion, Japan at 260% of GDP, Europe, drowning in unfunded pensions. Every bond issued, every rate swap written is another fuse connected to the same bomb. And beneath the surface, banks are bleeding quietly. JP Morgan holds $54 trillion in derivatives, 180 times its capital base. Citigroup, $48 trillion. Bank of America, $37 trillion. Goldman Sachs, $47 trillion. They insist it's hedged, that the risk is netted, that models ensure safety. So did Lehman Brothers, so did AIG, so did every empire before collapse. But the illusion is deeper this time. The complexity has evolved beyond human comprehension. Algorithms trade billions in contracts per second black boxes, making bets on volatility, yield curves, and cross-currency spreads. When they misfire, no one can pull the plug. No boardroom, no regulator, no president. The cascade would be faster than policy, larger than rescue, and global in seconds. We are told the system is stable. We are told the reforms worked. But every assurance sounds like 2007 calm words before the sirens. And now we are walking the same road they once did. Section 2. The new mirrors of power history doesn't repeat, it mutates. The 21st century empire isn't made of steel or soldiers. It's made of data derivatives and denial. The new towers of power are digital, their foundations, algorithmic, their rulers, invisible. Artificial intelligence now sits at the trading desk optimizing profit in nanoseconds, creating layers of exposure too complex for humans to trace. It doesn't understand risk, it only learns to chase it. Each new model compounds volatility, each self-learning algorithm becomes a trader with no fear, no ethics, no memory of 2008. This isn't human greed anymore, it's automated speculation at planetary scale. Meanwhile, the monetary order fractures. The US dollar, dominant for 8 decades, faces rebellion. Saudi Arabia accepts yuan for oil. China, Russia, and India settle trade in their own currencies. Every shift in the currency system reverberates through $100 trillion in FX derivatives, invisible tripwires stretched between nations. If one currency breaks, the chain reaction crosses oceans before dawn. And as trust evaporates, governments cling to control. Digital currencies, CBDCs, emerge as the new frontier, promising safety while ensuring surveillance. But they are built on the same unstable code belief. Once confidence breaks, no algorithm can restore it. We are witnessing the same arc that every empire faces. Expansion, euphoria, decay, denial. Each nation, each bank, each trader believes they will exit before the collapse. But nobody exits a system this interconnected. When it goes, it takes everything with it. Pensions, currencies, democracies. The warning signs are here: volatile interest rates collapsing, trust, weaponized data, unpayable debt. All of them mirror 2008 Rome, every empire that mistook leverage for strength. And when it falls this time, there will be no bailouts, no liquidity flood, no reset button. Because the system is now too large to rescue too fast, to control, and too entangled to unwind. We are not watching history repeat. We are standing inside its sequel. Every age believes it has transcended collapse, that technology, intelligence, and policy have defeated the laws of history. But history doesn't vanish. It waits. The $600 trillion derivatives market is not just a number. It is a mirror reflecting every illusion of modern civilization: that debt is wealth, that leverage is growth, that risk can be buried beneath mathematics. We have built a cathedral of promises on a foundation of sand, a structure so vast that it cannot be understood and therefore cannot be saved. When it falls, it won't look like 2008. It will be faster, deeper, and absolute. Liquidity will disappear in hours, banks will freeze, currencies will fracture, governments will respond, but their tools will fail because the weapon is not outside the system. It is the system. And yet the ending was always written into the beginning. Every empire built on excess ends the same way, not with invasion, but with implosion. Not from without, but from within. Perhaps this is the lesson hidden beneath the numbers: you cannot engineer permanence out of greed. You cannot hedge against gravity, and no algorithm can repeal the cycle of consequence. We were warned. Buffett called them financial weapons of mass destruction. Economists called them innovation. Politicians called them progress. But history calls them by their real name: reckoning. When the last derivative unwinds, when the screens go dark, and when the silence returns, we will finally see what was real and what was only leverage. Empires never fall from outside. They collapse from within.